Before we dive in, a quick but important note. I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and informational purposes only and should not be considered legal or financial advice. Always consult with a qualified professional before making any decisions about your insurance coverage. The average American driver overpays for car insurance by $417 every single year. Think about that for a second. That's a new PlayStation 5. It's a round-trip flight to a vacation you've been dreaming of. It's a significant dent in your credit card debt. And it's vanishing from your bank account for one simple reason. You're not asking the right questions. You see, buying car insurance isn't like buying a TV. You can't just compare prices on a screen and pick the cheapest one. Doing that is like walking into a hospital and telling the doctor, "Just give me the cheapest surgery you've got." It's a recipe for disaster. The insurance industry is a multi-billion-dollar machine that has mastered the art of confusion. They use complicated jargon, dense policy documents, and tempting lowball offers designed to do one thing: get your money while transferring as much risk as possible back onto you. But that ends today. In this video, I'm giving you the keys. I'm going to arm you with the 10 crucial questions you must ask before you sign any car insurance policy. These aren't just fluffy generic tips. These are the specific surgical questions that cut through the noise, expose the traps, and put you firmly in the driver's seat of the negotiation. By the end of this, you won't just save money, you'll buy peace of mind. You'll understand exactly what you're paying for, and be protected from the kind of financial nightmare that cripples families after a simple accident. So buckle up. Let's start with the first and arguably most misunderstood question of all. Question number 1. What are my state's minimum liability requirements, and why is settling for them a catastrophic mistake? Every agent you talk to, every website you visit, will present you with an option for state minimum coverage. It will always be the cheapest price on the list, sometimes by a significant margin, and it feels like a smart, frugal choice, right? You're following the law, you're saving money. What could possibly be wrong? Everything. Everything is wrong with that choice. State minimum liability coverage is a trap. It is the single biggest financial landmine in the world of personal insurance. Let me explain. Liability insurance doesn't cover you, your car, or your injuries. It covers the other person. It's your, "I'm sorry I messed up" fund. It's broken down into two main parts. Bodily injury liability, which pays for the other person's medical bills if you injure them, and property damage liability, which pays to repair or replace their car or any other property you damage, like a mailbox or a storefront. Every state has a law mandating a minimum amount for these coverages. For example, in a state like California, the minimum is 15/30/5. That sounds like a secret code, but it's simple. $15,000 for bodily injury to one person, $30,000 total for bodily injury per accident if multiple people are hurt, and a laughable $5,000 for property damage. $5,000. Have you seen the price of cars lately? The average cost of a new car in the United States is hovering around $48,000. Even a minor fender bender with a brand new Toyota Camry can easily result in $10,000 to $15,000 in damages. If you rear-end a Tesla, or a BMW, or a new Ford F-150, you could be looking at a $25,000, $30,000, or even $40,000 repair bill. Now let's play this out. You have that smart, cheap state minimum policy with $5,000 in property damage coverage. You cause an accident that results in $20,000 of damage to the other person's vehicle. Your insurance company will write a check for $5,000, wish you the best of luck, and walk away. Who pays the remaining $15,000? You do, out of your own pocket. And if you don't have 15 grand just sitting in a savings account, the other party's insurance company, or the person themselves, will sue you for it. And they will win. This is where the nightmare begins. Suddenly, you're facing wage garnishment, where they take money directly from your paycheck every single week. They can put a lien on your house. They can seize your assets. Your financial life, your credit score, your ability to get a loan for years to come can be completely destroyed, all because you tried to save $15 a month on your insurance premium. And we haven't even touched the medical side. The bodily injury minimum of $15,000 is even more dangerous. What do you think one trip to the emergency room, an ambulance ride, and a few x-rays cost? It's often more than 15 grand. What if the person you hit needs surgery? A single night in the hospital can cost thousands. If they have a serious injury, their medical bills could skyrocket into the hundreds of thousands of dollars. Again, your policy pays out its tiny limit, $15,000 or $30,000, and you are personally on the hook for every single penny above that. The lifetime of a person's medical care, their lost wages because they can't work, their pain and suffering. People lose their homes over this. They're forced into bankruptcy. This isn't a scare tactic. This is the grim reality that insurance claim adjusters see every single day. So what's the answer? When you ask an agent or a company, what are the state minimums? Your follow-up, the real question, should be, now show me a quote for what responsible people actually carry. The gold standard, the widely recommended level of liability coverage for a typical person, is what's known as 100/300/100. Let's break that down. $100,000 in bodily injury coverage per person, $300,000 in bodily injury coverage total per accident, and $100,000 in property damage coverage. Look at the difference. With $5,000 in property damage, you can't even cover the cost of totaling a 10-year-old Honda Civic. With $100,000, you're protected if you get into a multi-car accident involving several late-model SUVs. With $15,000 in bodily injury, you can barely cover the cost of a broken arm. With $100,000, you have a robust defense against the crippling lawsuits that come from a serious injury. And here's the kicker, the part they don't want you to focus on. The price difference between the dangerously low state minimum and a truly protective 100/300/100 policy is often shockingly small. We're not talking about double the price. We're often talking about an extra $20, $30, maybe $40 a month. It is the single best investment you can possibly make. You are trading a few lattes a month for a multi-$100,000 shield that protects your entire financial future. So, the first question is a test. By asking about the state minimum, you're not asking for a quote. You're testing the agent or the company. If they eagerly try to sell you that policy just to give you the lowest possible price, you know they don't have your best interests at heart. A good, ethical agent will immediately explain the risks, just as I have, and guide you toward a level of coverage that actually protects you. They'll tell you that the state minimum isn't a recommendation. It's a legal floor that hasn't kept up with the reality of medical costs and car prices for decades. It's a trap, and now you know exactly how to avoid it. So, avoiding that trap leads us to the second, and arguably one of the most important questions you can ask. Beyond the bare minimum liability, what types of coverage do I actually need? And what in the world do they all mean? This is where the fog of insurance jargon rolls in. It's where people get confused, overwhelmed, and ultimately underprotected. You've probably heard the term full coverage. Let me tell you a secret the insurance industry doesn't advertise. Full coverage isn't a real thing. It doesn't exist as a specific product. It's a slang term, a casual bundle of coverages that people use, but what's in that bundle can vary wildly. Assuming you have it can lead to financial ruin. Let me tell you about Sarah. Sarah was a smart, responsible person. She had a good job, a reliable car she was still making payments on, and she always paid her bills on time. She called an agent and asked for full coverage, paid her premium and felt secure. One rainy Tuesday afternoon, she was waiting at a red light when a pickup truck slammed into her from behind. The impact was violent, shoving her car into the intersection. Her airbags deployed, the rear of her car was completely crumpled, and she was left dazed with a searing pain in her neck and back. The police and ambulance arrived. The driver of the truck, it turned out, had let his insurance lapse. He had no coverage. Zero. Sarah wasn't worried at first. She had full coverage, right? She called her insurance company from the hospital, expecting them to handle everything. And that's when her world fell apart. She learned that her full coverage policy included the state minimum liability, which, as we know, only pays for damage she causes to others, and collision coverage. That was it. The agent on the phone delivered the devastating news. Her collision coverage would fix her car, but there was a $1,000 deductible she had to pay out of pocket first. Okay, painful but manageable. But then came the bombshell. Her policy had no coverage for her medical bills if she was hit by an uninsured driver. It had no coverage for the weeks of work she was about to miss during physical therapy. Her health insurance would kick in eventually, but she had a $5,000 deductible on that plan. Sarah was facing thousands in immediate medical costs, a $1,000 car repair bill, and lost income, all because a guy with no insurance made a mistake. Her own full coverage policy was failing her. She was the victim, yet she was the one facing financial catastrophe. Sarah's story is tragically common, and it perfectly illustrates why understanding the individual ingredients of your policy is non-negotiable. She was missing two of the most critical life-saving coverages you can buy. The first is uninsured and underinsured motorist coverage. Let's call it UM/UM. This is not for them, this is for you. It is your personal shield against the millions of irresponsible drivers on the road. The Insurance Research Council estimates that 1 in 8 drivers in America is uninsured. That's nearly 13%. In some states, it's as high as 1 in 4. Think about that. Every time you're on the road, one of the cars around you is likely a financial time bomb waiting to go off. If they hit you and injure you, your liability coverage does nothing. You could sue them, sure. But if they can't afford a $50 a month insurance premium, what makes you think they have $50,000 sitting around for your medical bills and lost wages? Suing them is like trying to get blood from a stone. This is where uninsured motorist coverage steps in. It acts as the insurance the other driver should have had. It pays for your medical bills, your pain and suffering, and your lost wages when you're hit by someone with no insurance. Underinsured motorist coverage does the same thing, but for when the at-fault driver has insurance, but not enough to cover your bills. Remember that guy with the $25,000 state minimum policy we talked about? If your medical bills are $100,000, his insurance pays the first $25K, and then your underinsured motorist coverage can step in to cover the remaining $75K. It is, without a doubt, one of the most important coverages you can carry. In some states it's required, but in many it's optional. Do not treat it as optional. Now let's talk about your car itself. This brings us to the dynamic duo of physical damage coverage, collision and comprehensive. People confuse these all the time, but the difference is simple. Collision coverage pays to repair or replace your car if you are in an accident with another object. Another car, a pole, a tree, a guardrail. It doesn't matter who is at fault. If you back into a parking garage column, collision covers it. If someone runs a red light and T-bones you, collision covers it. This is the coverage that gets your car back on the road after a crash. Without it, if you cause an accident, you're paying for your own repairs entirely out of pocket. If your car is worth more than a few $1,000s, or if you have a loan or lease on it, this is an absolute must-have. In fact, your lender will require it. But what about everything else? What about all the bad things that can happen to your car that aren't a collision? This is where its partner, comprehensive coverage, comes in. Think of comprehensive as the acts of God and chaos coverage. Protects you from things other than a collision. A hailstorm turns your car into a golf ball? That's comprehensive. A deer jumps out on a country road and you hit it? That's comprehensive. A tree branch falls on your hood during a storm? Comprehensive. Your car is stolen from your driveway? Comprehensive. Someone keys your door or smashes your window? Vandalism is covered by comprehensive. Floods, fire, riots, all of it falls under comprehensive. It covers an incredible range of random, unpredictable events that can total your car just as easily as a car crash. Imagine buying a brand new $40,000 SUV. 2 weeks later, a freak hailstorm passes through, causing $20,000 in damage. Without comprehensive coverage, your insurance company pays you nothing. Zero. You are now stuck with a $20,000 repair bill, or a car that's worth half of what you owe the bank. It's a nightmare. So, when you hear full coverage, what people usually mean is a policy that includes liability, collision, and comprehensive. But as Sarah's story showed us, even that isn't enough. A truly robust policy needs more. It needs uninsured/underinsured motorist coverage. And for your own well-being, it likely needs one more piece of the puzzle: medical payments coverage, often called MedPay, or in some states, a more robust version called personal injury protection, or PIP. This coverage is for your initial medical expenses after an accident, regardless of who is at fault. Think of it as first aid for your wallet. If you have a $5,000 health insurance deductible, a $5,000 MedPay policy can cover that deductible for you and your passengers immediately, without waiting for fault to be determined. It can cover ambulance rides, ER visits, dental work if you injured your teeth, things that need to be paid right away. In no-fault states, personal injury protection is mandatory and goes even further, often covering a portion of lost wages and other related expenses. But even in states where it's optional, having a few $1,000s in MedPay is an incredibly smart, and usually very cheap, addition to your policy. It removes that initial financial shock after an accident and gives you breathing room. So the second question isn't just about adding more coverage, it's about building a fortress. Your liability coverage is the outer wall, protecting you from lawsuits from others. But your uninsured motorist, collision, comprehensive, and MedPay coverages are the walls of the castle keep. They protect you. They protect your health, your vehicle, and your financial stability when disaster strikes. Asking for full coverage is like asking a builder for a house. A good builder will stop you and ask, "Okay, but how many bedrooms? What kind of foundation? What kind of roof?" You need to be that specific with your insurance. You need to be the architect of your own protection. And the very first blueprint you need to draw, the absolute foundation of your financial safety, is for your liability coverage. This brings us to the third and frankly the most life-altering question you must ask. What are my liability limits and are they high enough? Now, if you're like most people, your eyes just glazed over a little bit. Liability limits. Sounds like boring insurance jargon. It's not. This is the number that determines whether you walk away from a bad accident with your life intact, or whether you walk away from a bad accident and into financial ruin for the next 30 years. I am not exaggerating. Liability coverage has nothing to do with fixing your car. It has everything to do with paying for the damage you cause to other people and their property. Every state, except for a couple with weird rules, requires you to have a minimum amount of it. This is called the state minimum. And I'm here to tell you that the state minimum is a trap. It's a financial landmine disguised as a good deal. Let me tell you a story about a guy we'll call David. David is a good guy. He's 35, works in IT, has a wife, a couple of kids, a modest house in the suburbs, and about $20,000 in savings. He's a responsible person. But when it came to car insurance, he did what millions of people do. He looked for the cheapest possible option that was still legal. He bought a state minimum policy. In his state, that meant his policy would pay out a maximum of $25,000 for injuries to one person, $50,000 total for injuries to everyone in an accident, and just $25,000 for property damage. He saw that low monthly premium and thought, "I'm saving money. I'm being smart." One Tuesday afternoon, he was driving home. He glanced down at his phone for just a second to check a notification. A split second. But in that split second, the traffic ahead of him stopped. He slammed on his brakes, but it was too late. He rear-ended the car in front of him. It wasn't a high-speed crash. The airbags didn't even go off. Just a solid jarring thud. David got out, his heart pounding. The car he hit was a brand new Audi A8. The driver was a woman in her 40s. She was shaken up, complaining of neck pain, but seemed okay. They exchanged information. David's car had a crumpled hood, but it was drivable. He called his insurance company, filed the claim, and thought the worst was over. He was wrong. The nightmare was just beginning. A week later, the calls started. First, the body shop. The estimate to repair the Audi, with all its sensors, cameras, and specialized aluminum parts, was $32,000. David's smart insurance policy only covered $25,000 in property damage. Right away, he was personally on the hook for the extra $7,000. He had to drain a huge chunk of his family's savings to pay it. It was painful, but he thought, okay, lesson learned. At least it's over. It wasn't over. The woman he hit was a dentist. The neck pain turned out to be a serious whiplash injury that required surgery and months of physical therapy. She couldn't work. Her medical bills alone soared past $80,000. David's policy only covered $25,000 for her injuries. That left a $55,000 gap. But it got worse. Because she was a dentist, a highly skilled professional, her lost income from being unable to work for 6 months was calculated at over $200,000. So let's do the math. $7,000 for the car, $55,000 for the medical bills, $200,000 for lost income. David was now personally responsible for over $250,000, all from a 2-second glance at his phone. He was sued. He had no choice but to settle because he would have lost in court. The settlement wiped out the rest of his savings. They had to take out a second mortgage on their house. And for the next 15 years, a percentage of his paycheck was automatically garnished to pay off the debt. That one cheap insurance policy cost him his family's financial security, their dreams of paying for their kids' college, their retirement. It derailed their entire life. The purpose of liability insurance is not to protect your car. It is to protect your house, your savings, your investments, your future paychecks. It is a shield for your entire financial life. The question you should ask isn't, what is the legal minimum? It's, how much do I have to lose? If you own a home, if you have savings, if you have a decent job, the state minimum is playing Russian roulette with your family's future. So what's the right amount? Most experts recommend liability limits of at least $100,000 per person, $300,000 per accident, and $100,000 for property damage. This is often written as 100/300/100. And you know what? The difference in cost to go from the pathetic state minimum to this level of real protection is often just a few dollars a month. It is the single best investment you can make. If you have significant assets, you should look into even higher limits or a separate umbrella policy. Okay, deep breath. So you've built the foundation. You've used liability coverage to build a fortress around your assets. But what about the car you're actually driving? What protects that investment? That's question number 4. Should I get collision and comprehensive coverage? This is where we talk about fixing your car. Let's make this simple. These two coverages are often bundled together, but they do different things. Collision is exactly what it sounds like. It pays to repair or replace your car if you collide with something else. That could be another car, a telephone pole, a guardrail, a garage door. Crucially, it covers you even if the accident is your fault. Without collision, if you cause an accident, your liability insurance pays for the other person's car, and you get a check for exactly $0 to fix your own. You're left walking. Comprehensive, sometimes called other than collision, is for almost everything else. It's for the random, unpredictable acts of nature and misfortune. A tree branch falls on your car during a storm. A deer decides to play chicken with your front bumper on a country road. A hailstorm makes your roof look like a golf ball. Your car gets stolen, catches on fire. A rock flies up on the highway and cracks your windshield. All of that's comprehensive. So do you need them? Unlike liability, these are not usually required by law. The answer depends on a simple, cold, hard calculation. First, if you have a loan or a lease on your car, the answer is yes. You need both. In fact, your lender or leasing company will contractually require you to have them. They have a financial interest in that vehicle, and they want to make sure their investment is protected until you pay it off. But if your car is paid off, the choice is yours. And here's how you decide. Ask yourself one question. If my car were totaled tomorrow, could I afford to go out and replace it without causing a major financial crisis for my family? If your car is a 15-year-old beater worth maybe $2,000, paying an extra $40 a month for collision and comprehensive is probably a waste of money. You're better off putting that cash in a new car savings account. But if you're driving a car worth $10,000, $20,000, or $50,000, and you don't have that kind of cash just sitting around, then you absolutely need these coverages. They are the armor that protects your vehicle. Now, here's the pro tip for making this armor affordable. The deductible. The deductible is the amount of money you pay out of pocket for a repair before the insurance company pays a dime. For both collision and comprehensive, you can choose your deductible, typically ranging from $250 to $2,000. Here's the secret. Raising your deductible from, say, $500 to $1,000 can dramatically lower your monthly premium. You're telling the insurance company, "Look, I can handle the small stuff. I'll cover the first $1,000 of damage myself. I just need you to protect me from the big catastrophic loss." This is one of the easiest ways to save significant money while still being fully protected against a major disaster. So you've shielded your assets from lawsuits with high liability limits, and you've armored your car against damage with collision and comprehensive. You might think you're fully covered, but you're not. There's a glaring hole in this plan, a hole that involves your own body and your own passengers. What happens when you're the one who needs medical care after a crash? Who pays for that? The answer is more complicated and far more important than you think. This brings us to the fourth and arguably the most selfishly important question you need to ask. What coverage pays for my medical bills and the bills of my passengers? Let's be brutally honest for a moment. Most of us think about car insurance backwards. We worry about paying for the other guy's brand new Mercedes that we might scratch. We worry about getting sued, but we spend far less time thinking about the one thing that is irreplaceable, our own health and well-being. We think, "Oh, I have health insurance. I'm fine." That single thought is one of the most dangerous and potentially bankrupting assumptions you can make. Imagine this scenario. You're driving home, obeying every law, and someone runs a red light, T-boning your car. It's a bad one. You're rushed to the hospital. Your passenger or friend is also injured. The police report clearly states the other driver was 100% at fault. So, their bodily injury liability insurance should cover everything, right? Problem solved. But what if that driver has no insurance? Right now, in America, about 1 in every 8 drivers on the road with you is uninsured. 1 in 8. That's like playing a game of Russian roulette every time you merge onto the freeway. And even if they do have insurance, what if they only have the state minimum? In some states, that's just $15,000 for bodily injury. Your first ambulance ride and a night in the ER could eat through that entire amount before you even see a specialist. Suddenly, you're the victim of an accident that wasn't your fault, and you're facing a mountain of medical debt. Your health insurance kicks in, sure, but you're still on the hook for your $5,000 deductible. You have endless copays for physical therapy. And what about your friend in the passenger seat? Your health insurance certainly isn't going to pay a dime for their injuries. Now you have a potential lawsuit on your hands from your own friend, not out of malice but out of necessity because they have bills to pay. And the worst part? Your health insurance doesn't pay your mortgage. It doesn't put food on the table when you can't work for 6 weeks because of your injuries. This is not a scare tactic. This is a daily reality in emergency rooms across the country. It's the gaping hole in your financial armor. And it's plugged by 3 crucial types of coverage that you cannot afford to ignore: medical payments, personal injury protection, and uninsured/underinsured motorist coverage. Let's start with the simplest one, medical payments coverage, often called MedPay. Think of MedPay as the EMT of your car insurance policy. It's designed to be fast, immediate, and to work regardless of who is at fault. If you're in an accident, MedPay steps in right away to cover medical expenses for you and anyone else in your car. We're talking ambulance rides, emergency room visits, doctor's bills, dental work if you chip a tooth on the steering wheel, even funeral expenses in a worst-case scenario. It's typically sold in smaller amounts, $1,000, $5,000, maybe $10,000. And you might be thinking, why do I need that if I have health insurance? Fantastic question. First, MedPay can pay your health insurance deductible. That immediate out-of-pocket expense you'd have to cover, MedPay can handle it. Second, MedPay has no networks. Your health insurance might be an HMO that wants you to see specific doctors. After a car wreck, you want the best care, period. Not just the care that's in-network. MedPay doesn't care about networks. Third, and this is huge, it covers your passengers. Your health insurance covers you. MedPay covers your kids, your spouse, your friends, your carpool buddy. It protects the people you care about in your car without them having to go through their own insurance or worse, sue you. For the relatively low cost, a solid MedPay limit is one of an intelligent person's best friends. Now, if you live in one of about a dozen no-fault states like Florida, Michigan, New York, or Pennsylvania, the game changes. In these states, you'll be required to have something called personal injury protection, or PIP. PIP is like MedPay on steroids. It does everything MedPay does, but it goes much, much further. The core idea of a no-fault system is to reduce lawsuits by having each driver's own insurance cover their initial injuries, regardless of who caused the accident. So, PIP not only covers your medical bills, it also covers things that can be even more financially devastating. The biggest one, lost wages. If you're a contractor or freelancer, or you just don't have good short-term disability insurance through your job, a car accident that takes you out of work for a month can be a financial death sentence. PIP can replace a percentage of your lost income while you recover. This is a lifeline. It keeps your family afloat. Beyond that, PIP can cover essential services. For example, if you're a stay-at-home parent and you break your leg in a crash, you can't take care of your kids. PIP can help pay for childcare while you're incapacitated. It can pay for someone to clean your house or mow your lawn if your injuries prevent you from doing it. It's designed to help you maintain your life, not just patch up your body. If you live in a no-fault state, your PIP coverage is one of the most powerful tools in your entire policy. Do not skimp on it. But the real heavyweight champion, the coverage that protects you from the absolute worst-case financial scenario, is uninsured and underinsured motorist bodily injury coverage. Let's call it UM/UM. This is your shield against the 1 in 8 drivers who are breaking the law and driving without insurance. It's your protection against the millions more, who only carry the bare minimum required by law. Here's how it works. If you are hit by a driver with no insurance, or not enough insurance to cover your medical bills, your UM/UIM coverage steps in and acts like their insurance policy. It pays for everything their bodily injury liability should have paid for. Your medical bills, your pain and suffering, your lost wages, all of it. Let's revisit our nightmare scenario. The guy runs the red light. You have $100,000 in medical bills and you're out of work for 3 months. He has no insurance. You're facing ruin. But you were smart. You bought UM/UIM coverage with limits of $250,000 per person. Now, instead of chasing a ghost and trying to sue an individual who probably has no assets, you make a claim against your own insurance company. Your insurer pays your bills and covers your lost income up to your limit. They then take on the burden of going after the at-fault driver to get their money back. That's their problem, not yours. You are made whole. You can focus on recovery, not bankruptcy. This is not an exotic, rare add-on. This is a fundamental piece of protection. The single best piece of advice you will ever get about car insurance is this: your uninsured motorist limits should always be equal to your own bodily injury liability limits. If you have enough coverage to protect a stranger from financial ruin if you hit them, you absolutely must have enough coverage to protect yourself and your own family from that same ruin if a stranger hits you. To do anything less is a gamble you cannot afford to lose. So when you're on the phone with an agent, you don't just ask, "Am I covered?" You ask specifically, "What are my limits for MetPay or PIP? What are my limits for uninsured and underinsured motorist bodily injury? Are they high enough to cover a serious injury? And do they match the liability coverage I'm carrying to protect others?" Because protecting your assets is one thing. Protecting your ability to walk, to work, to live without crippling debt is another thing entirely. It's everything. Now you've done it. You've built a fortress. You've got liability to protect your assets from others. You've got MetPay, PIP, and UM/UIM to protect your body and your bank account from others. You are financially shielded from the two biggest risks on the road. But there's still one massive, expensive piece of the puzzle sitting in your driveway. We've talked about what happens when you damage their car, and what happens when they damage your body. But what about when your own car, your $10,000, $20,000, or $50,000 asset, is a twisted wreck on the side of the road, or gets stolen from your apartment complex, or gets crushed by a falling tree? Who pays to fix or replace your car? The answer to that involves two of the most commonly misunderstood coverages in the entire insurance world, and getting them wrong can cost you thousands. These two coverages are called collision and comprehensive, and understanding the difference isn't just a fun fact for a trivia night. It's the bedrock of protecting your own vehicle. Let's break it down with a simple analogy. Imagine your car is a knight in shining armor. Collision coverage protects your knight when he's actively in a battle, clashing with another knight, running into a castle wall, or tipping over his jousting horse. Comprehensive coverage protects your knight from everything else: a dragon swooping down and breathing fire on him, a wizard casting a hailstorm spell, or a thief sneaking in at night and stealing his armor. One is about impact with another object. The other is about, well, life. Let's start with collision. This is the big one. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. The most important phrase there is regardless of who is at fault. Let me say that again, regardless of who is at fault. This is your ultimate safety net. Picture this: you're driving home, you get distracted for just a second, and you rear-end the car in front of you. It's a textbook at-fault accident. Your bodily injury and property damage liability, the stuff we talked about before, is going to pay for the other person's medical bills and to fix their car. But who pays for your crumpled hood and shattered headlights? You do, unless you have collision coverage. With collision, you pay your deductible, and your insurance company handles the rest. Without it, you're looking at a repair bill for thousands of dollars, or worse, you're just out of a car. But what if it's not your fault? Let's say someone runs a red light and T-bones you. It's clearly their fault. Their insurance should pay, right? Yes, in a perfect world. But what if they have no insurance or not enough insurance? What if they argue it was your fault and it becomes a months-long legal battle? You need your car now. You can't wait for lawyers to figure it out. This is where collision coverage becomes your hero. You file a claim with your own insurance company. They pay to get your car fixed immediately, minus your deductible. Then they go to war for you. They'll chase down the at-fault driver and their insurance company to get that money back, including your deductible. This process is called subrogation, and it means you have a multi-billion-dollar company fighting on your behalf so you don't have to. You get your car back, and eventually you get your deductible back, all without the headache. That peace of mind is what you're paying for. Now let's talk about comprehensive coverage. The official name is actually other than collision coverage, which is a perfect description. It covers damage to your car from almost everything except a collision. This is the coverage for all the random, unpredictable chaos the world can throw at your vehicle. A tree branch falls on it during a storm. A flash flood sweeps through your neighborhood. You're driving down the highway and a rock flies up and cracks your windshield. Someone breaks into your car and steals your stereo. Someone keys your paint job out of spite. Your engine block catches on fire. And here's the big one that surprises everyone. Hitting an animal. If a deer jumps out in front of you and you hit it, that is not a collision claim. That is a comprehensive claim. Why? Because the deer is considered an unpredictable, flying object. It's an act of nature. However, if that deer causes you to swerve and you hit a tree, now you're looking at a collision claim. It sounds strange, but the distinction matters. So, the fifth and critically important question you need to ask is, do I actually need collision and comprehensive coverage? Unlike liability insurance, no state in the country legally requires you to carry collision or comprehensive. This is an optional coverage. So why does almost everyone with a newer car have it? 2 reasons. First, and most importantly, if you have a loan on your car or you are leasing it, your lender or leasing company will absolutely 100% require you to have both. No exceptions. Why? Because until you pay off that loan, you don't fully own the car. The bank does. And they are not going to let their multi-thousand-dollar asset drive around unprotected. If you get into an accident and total the car, they want their money back. The insurance check ensures they get paid. If you try to remove these coverages while you still have a loan, the bank will find out and they will either buy a policy for you at an insanely high price and add it to your loan payment, or they could even repossess the car. So, if you're financing or leasing, the answer is simple: yes, you need them. But what if you own your car outright? The title is in your name, free and clear. Now, it becomes a very personal financial decision. You have to look in the mirror and ask yourself one brutally honest question. If my car were totaled tomorrow in a flood or an accident, could I afford to replace it with a reliable vehicle using my own money, without putting my family in a tough financial spot? If the answer is no, you probably need the coverage. If the answer is yes, then you need to do a little cost-benefit analysis. A great rule of thumb is the 10% rule. Look up the current private party value of your car on a site like Kelley Blue Book. Then, look at your insurance policy and see how much you're paying per year specifically for the collision and comprehensive portion. If the annual premium for that coverage is more than 10% of your car's value, it might be time to consider dropping it. For example, let's say you have a 12-year-old car worth about $3,000. The collision and comprehensive coverage is costing you $400 a year. That's over 13% of the car's value. In this case, you're paying a lot to protect a small asset. It might make more sense to drop the coverage, take that $400 you're saving, and put it into a dedicated new car savings account. You're essentially self-insuring. Over a few years, you'll have saved enough to cover a major repair or a down payment on a new car. On the other hand, if your car is worth $20,000 and the coverage costs you $700 a year, that's only 3.5% of the car's value. Dropping it would be like canceling fire insurance on your house to save a few bucks. The risk is just too high for the relatively small reward. Now, whenever you talk about collision and comprehensive, you have to talk about your deductible. The deductible is the part of the repair bill that you agree to pay out of pocket before the insurance company starts paying. They apply separately to collision and comprehensive claims. You might have a $500 deductible for collision and a $250 deductible for comprehensive. This is how it works. You hit a patch of ice and do $4,000 worth of damage to your car. You have a $500 collision deductible. You pay the body shop the first $500. Your insurance company pays the remaining $3,500. The deductible is how you control your premium. It's a simple trade-off. The higher your deductible, the lower your monthly premium will be. The lower your deductible, the higher your premium will be. Choosing a higher deductible signals to the insurance company that you're willing to take on more of the initial risk, so they reward you with a lower rate. So what's the right deductible? The answer is the highest deductible you can comfortably afford to pay on a moment's notice. Don't pick a $2,000 deductible just to save $20 a month if you don't have $2,000 in your emergency fund. That's a recipe for disaster. But if you have a healthy emergency fund, raising your deductible from, say, $250 to $1,000 can save you a significant amount of money over the life of your policy. Money that could be better used elsewhere. So you've analyzed your liability limits to protect your assets from a lawsuit. And now you've figured out how to protect the value of your actual car with collision and comprehensive coverage, and you've set a deductible you can live with. Your financial fortress is almost complete. You've protected the other guy, and you've protected your car. But what about the most valuable thing in the car? You and your passengers. What happens if you're injured in an accident? Who pays for your ambulance ride, your hospital stay, your physical therapy, your lost wages from being out of work? The answer depends entirely on where you live and a critical choice you make on your policy. A choice that can be the difference between financial ruin and a full recovery. This brings us to question number 6, a question that shifts the focus from protecting others to protecting the single most important thing in any accident, you and your passengers. The question is, should I get medical payments or personal injury protection, and how much is enough? Let's be brutally honest for a moment. In the chaotic seconds after a crash, your first thought isn't about the other driver's policy limits. It's about the searing pain in your wrist, the cut on your forehead, or the terrifying silence from the back seat. You need medical attention and you need it now. The problem is, medical care isn't free, and the bill arrives long before any settlement check does. This is where your own policy steps in to become your first line of financial defense. Depending on your state, you'll have a choice between 2 types of coverage designed to handle your immediate medical needs. Medical payments coverage, often called MedPay, and personal injury protection, universally known as PIP. They sound similar, but they are worlds apart in what they can do for you. Let's start with the powerhouse, personal injury protection, or PIP. If you live in one of the dozen or so no-fault states like Florida, Michigan, or New York, you don't have a choice. You are required to carry PIP. And honestly, that's a good thing. The term no fault can be confusing. It doesn't mean no one is to blame for an accident. It simply means that when it comes to your initial injuries, it doesn't matter who was at fault. Your own insurance company pays for your medical bills up to your PIP limit immediately. No waiting for lawyers to argue. No haggling with the other driver's adjuster. While you're trying to schedule physical therapy, your coverage pays first so you can heal. But PIP is so much more than just a medical fund. This is its superpower. PIP is designed to make you whole again after an accident, and it understands that your injuries are more than just doctor's bills. Imagine you're a freelance web developer. You get rear-ended and you suffer a severe concussion and 2 broken fingers. You can't look at a screen without getting a migraine, and you certainly can't type. Your work, your income vanishes overnight. This is where PIP steps in like a financial superhero. Not only does it pay for your emergency room visit, the CT scan, and the specialist appointments, but it also covers a significant portion of your lost wages. While you're recovering, money is still coming in to pay your rent, your car payment, your groceries. The stress of financial ruin is lifted, allowing you to focus purely on getting better. But it doesn't even stop there. Let's say your injury makes it impossible to do daily tasks. You can't cook, you can't clean, you can't even take care of your kids. PIP can cover what are called essential services. It can pay for someone to come clean your house, a meal delivery service, or childcare while you're incapacitated. It is a comprehensive safety net designed for the real-world consequences of an injury. It even covers funeral expenses in a worst-case scenario. PIP is a broad, powerful coverage that protects not just your body, but your entire life and livelihood. Now let's travel to an at-fault state, like California or Ohio. Here you won't find PIP. Instead, you'll be offered its leaner, more focused cousin, medical payments coverage, or MedPay. MedPay has a much simpler job. Its primary purpose is to pay for necessary medical and funeral expenses for you and your passengers, regardless of who is at fault. Think of it as a dedicated, no questions asked health fund for car accidents. It has no deductible and no copay. If you have a $5,000 MedPay limit, you have $5,000 of immediate cash to throw at medical bills. So, why would you need this if you have health insurance? This is the key question people ask, and the answer has 3 parts. First, the deductible. The average American family has a health insurance deductible of over $4,000. If you get into an accident and need a $10,000 surgery, your health insurance will happily pay for it, after you pay the first $4,000 out of your own pocket. If you have $5,000 in MedPay, your car insurance pays that deductible for you. You pay nothing. That alone makes it worth its weight in gold. Second, your passengers. You're driving your friend to lunch. You get into a minor fender bender, but the jolt gives your friend whiplash. They don't have great health insurance. It's an incredibly awkward situation. Are they supposed to sue you to get their bills paid? With MedPay, there's no awkwardness. Your policy can pay for their emergency room visit and follow-up appointments right then and there. It protects your relationships as much as it protects your finances. And third, speed and simplicity. Even with great health insurance, sometimes certain treatments like chiropractic care or specific types of therapy can be a fight to get approved. And your health insurance company will almost certainly go after the at-fault driver's insurance to get their money back. a process called subrogation that can complicate and delay your settlement. MedPay just pays the bill. It's fast, it's clean, and it acts as a perfect buffer between the chaos of an accident and your personal finances. So, we come back to the core question: how much do you need? This isn't a number you pull out of thin air. It's a calculated decision based on your specific life. First, look at your health insurance policy. What is your deductible? What is your out-of-pocket maximum? At a bare minimum, your MedPay or PIP coverage should be enough to cover your health insurance deductible, so a minor accident doesn't drain your savings account. If you have a high deductible plan, you need more MedPay. If you have no health insurance, you need to buy the absolute maximum PIP or MedPay you can possibly afford. It will be your only lifeline. Second, analyze your income and your job. Are you a salaried employee with generous sick leave? Or are you a gig worker, a freelancer, or a small business owner whose income stops the second you stop working? If you're in the latter group, the lost wages component of PIP is not a luxury. It is an absolute necessity. You should consider buying much more than the state minimum. A policy that offers 80% of your lost wages for up to a year could be the only thing that keeps your business from collapsing after a serious injury. Third, consider who you drive with. Do you have kids? Do you carpool with coworkers? Do you frequently drive elderly parents to appointments? Your PIP or MedPay covers every single person in your car. Buying a higher limit is an act of responsibility and care for the people you share your vehicle with. It ensures that if an accident happens, they have immediate access to medical care without financial worry. And finally, look at the cost. Here's the secret that insurance companies don't shout from the rooftops. MedPay and additional PIP are often shockingly inexpensive. We're talking about the price of a few cups of coffee a month. Increasing your MedPay from $5,000 to $25,000 might only add a few dollars to your premium. For the sheer level of financial protection and peace of mind it provides, it is arguably the single best bargain in the entire world of insurance. So when you're building your policy, don't just accept the default or the state minimum for these coverages. Don't just say, "Oh, I have health insurance, I'm fine." That's a dangerous assumption. An accident creates immediate needs, and health insurance is not an immediate solution. It has gaps, it has delays, and it does absolutely nothing to replace your lost income. You need to ask your agent to quote you several different levels of MedPay or PIP. See the actual price difference between a $10,000 policy and a $50,000 policy. You will likely be stunned at how affordable that extra layer of security is. This coverage is your personal safety net. It's the fund that pays the ambulance bill on the spot, the coverage that keeps your income flowing when you can't work, the protection that takes care of your friends and family. It's what separates a medical inconvenience from a full-blown financial catastrophe. But even with the best PIP or MedPay, there's still a terrifyingly common scenario that can leave you with hundreds of thousands of dollars in bills. A scenario that happens on American roads hundreds of times every single day. And this scenario is the great, tragic irony of car insurance. You can do everything right. You can be the safest driver on the road. You can pay your premiums on time every single month. You can have the best liability coverage, the best collision coverage, the best medical payments coverage. You can be stopped at a red light, in broad daylight, singing along to the radio. And in a single violent instant, your entire financial future can be obliterated by someone else's mistake. Someone who decided that paying for car insurance was optional. This brings us to the single most important question you can ask to protect yourself from the financial irresponsibility of others. Question number 7. What happens if the person who hits me has no insurance or not enough? Let's be brutally honest. We all share the road with millions of people we don't know. We are, in effect, trusting them with our lives and our financial well-being every time we get behind the wheel. But what if that trust is misplaced? What if the person in the beat-up sedan texting in the lane next to you let their insurance lapse 3 months ago? What if the young driver who just ran a stop sign and T-boned you is only carrying the bare minimum insurance required by law? This isn't some rare freak occurrence. According to the Insurance Research Council, on average, 1 in every 8 drivers in the United States is uninsured. That's more than 12% of the cars on the road. In some states, it's a staggering 1 in 4. Think about that. On your commute to work today, you likely pass dozens, if not hundreds, of drivers with absolutely zero insurance. They are financial time bombs on wheels, and if one of them hits you, you become the one who has to deal with the fallout. You might think, well, I'll just sue them. And you can. You can hire a lawyer, go to court, and you might even win a judgment for hundreds of thousands of dollars. But here's the harsh reality. What are you going to collect? The type of person who drives without insurance is very often the type of person who has no significant assets to seize. It's called being judgment-proof. You can't get blood from a stone, and you can't get $100,000 from a person with a negative bank account and a part-time job. Your court victory becomes a worthless piece of paper, while your medical bills, your lost wages, and your pain and suffering are devastatingly real. This is where the most criminally overlooked and misunderstood part of your policy comes into play: uninsured and underinsured motorist coverage. Often abbreviated as and UIM, this coverage is not for them. It's for you. It is your personal shield against the 32 million uninsured drivers on American roads, and the tens of millions more who are dangerously underinsured. Let's break it down. First, uninsured motorist coverage, or This is straightforward. If you are hit by a driver who has zero insurance, your coverage steps in and acts like the insurance they should have had. It can pay for your medical bills, your passengers' medical bills, and in many states, it can also cover lost wages and even compensation for pain and suffering. It essentially fills the massive, terrifying gap left by the other driver's irresponsibility. It also covers you in the case of a hit and run, where the other driver is unidentified and therefore, effectively uninsured. But the second part is just as critical. Underinsured motorist coverage, or UIM. This is the one that trips people up. This protects you from the millions of drivers who did the bare minimum. They bought a car insurance policy, but they bought the cheapest one they could find, the state minimum requirement. Let's look at a state like California. The minimum bodily injury liability they require a driver to carry is $15,000 per person and $30,000 per accident. In Florida, it's just $10,000. Now, that might sound like a decent amount of money, but a single ambulance ride, an emergency room visit, an MRI, and a few stitches can easily exceed $15,000. What if you need surgery? What if you're out of work for 6 months? That $15,000 will be gone before your first physical therapy session. So let's say you're in a serious accident. Your medical bills are $150,000. The person who hit you and caused the accident has a state minimum policy of $25,000. Their insurance company will write you a check for $25,000 and that's it. They fulfilled their legal obligation. You are now left with a $125,000 hole. Where does that money come from? It comes from your health insurance, your savings, your retirement fund. Comes from selling your home. Unless you have underinsured motorist coverage. With UIM, after the other driver's insurance pays their $25,000 limit, your own insurance company steps in. Your UIM coverage will then pay the remaining $125,000, up to the limit you selected. You are made whole not because of the person who hit you, but because you had the foresight to protect yourself. So how much of this coverage should you get? The answer is simple and non-negotiable. You should have the exact same amount of uninsured and underinsured motorist coverage as you have for your own bodily injury liability coverage. Let me repeat that, because it is the single most valuable piece of advice in this entire series. Mirror your liability limits. Think about it. In question 4, we talked about bodily injury liability. That's the coverage that protects your assets if you cause an accident and injure someone else. Let's say you chose $250,000 of liability coverage because you have a house, savings, and a future you want to protect. You've made a rational decision that an accident could cause at least that much damage to another person. So why on earth would you value your own health, your own body, your own ability to earn an income any less than that? If you believe you need $250,000 to protect you from a lawsuit, you absolutely must have $250,000 to protect you when someone else shatters your life and can't pay for it. To do anything else is to essentially say that a stranger's financial well-being is more important than your own. And here's the crazy part. This vital life-saving coverage is shockingly inexpensive. We're often talking about a few extra dollars a month to add hundreds of thousands of dollars in protection. People will decline it to save $6 a month, completely oblivious to the fact that they are exposing themselves to a $500,000 risk. It is, without a doubt, the best bargain in all of insurance. When you're getting a quote, the agent may ask, "Do you want to add uninsured motorist?" Your answer is not just yes. Your answer is, "Yes, I want my uninsured and underinsured motorist limits to be exactly the same as my bodily injury liability limits." Don't let them default you to a lower amount to make the quote seem cheaper. Insist on mirroring them. In some states, you might also be offered the option to stack your UM/UIM coverage. If you have, say, 2 cars on your policy, stacking allows you to combine the coverage limits. So if you have $100,000 of UM coverage on each car, In a stack policy, you would have $200,000 of total coverage available if you're hit by an uninsured driver. It costs a little more, but it's a powerful way to multiply your protection. Ask your agent if stacking is available and how it works in your state. Protecting yourself with liability coverage is responsible. Protecting your car with collision coverage is smart. But protecting yourself with uninsured and underinsured motorist coverage, that's an act of profound self-defense. You are building a financial fortress, not just around your assets, but around your body, your health, and your family's future, shielding them from the carelessness of millions of strangers. So now you're protected from your own mistakes, your own medical bills, and even from other people's mistakes. You're basically invincible, right? Wrong. There's another type of damage, one that has nothing to do with physical impacts or medical bills, that can still cost you thousands, and it's something most people think is automatically included in their full coverage policy. That hidden cost, that non-physical damage we're talking about, is called depreciation. And if you have a car loan, it can be your absolute worst enemy. It's the invisible force that starts draining the value from your car the second you drive it off the lot. A brand new $40,000 car might only be worth $35,000 a month later. That's $5,000 of value that has vanished into thin air. Now, why does this matter? Because in the event of a major accident where your car is declared a total loss, your insurance company doesn't care what you paid for it. They don't care what you owe on it. They only care about one thing, its actual cash value or ACV at the moment right before the crash. But your lender? They only care about what you owe them. And very often, especially in the first few years of a loan, there is a massive, terrifying gap between those two numbers. This brings us to the eighth, and for many people, the most financially crucial question you must ask. Do I need gap insurance? To understand why this is so important, let me tell you about a woman named Jessica. Jessica just landed a great new job. To celebrate, and because she needed a reliable ride for her new commute, she bought her dream car. A brand new, fully loaded SUV. It cost $42,000. She was so proud. She put down $4,000, a decent down payment, and financed the remaining $38,000. She called her insurance company, told them she needed the works. Full coverage, comprehensive, collision, the highest liability limits. She felt completely protected, invincible even. For 8 months, everything was perfect. Then one rainy Tuesday afternoon, she was waiting at a red light when a truck, going way too fast for the conditions, couldn't stop. It slammed into the back of her SUV, shunting her into the intersection where she was hit again by another car. The airbags deployed, the car was a mangled wreck, but thankfully, Jessica walked away with just bruises and a bad case of whiplash. A week later, after the tow yard inspection, she got the call from her insurance adjuster. "Good news, Jessica," he said. "We've completed our assessment. The bad news is the vehicle is a total loss, but we've calculated the actual cash value at $31,000. We'll just subtract your $500 deductible, and we'll be sending a check for $30,500 directly to your lender to pay off the loan." Jessica was confused. "Wait," she said. "31,000? I owe way more than that." She pulled up her loan statement on her phone. Her heart sank. After 8 months of payments, she still owed $36,200 on her loan. The adjuster's voice was sympathetic but firm. "I understand, but our policy is to pay the current market value of the vehicle. That's what it was worth right before the accident. Depreciation on a new vehicle is significant in the first year." Jessica did the math in her head, her hands starting to shake. The insurance company was sending a check for $30,500 to her bank, but she owed the bank $36,200. That left a difference, a gap of $5,700. The reality hit her like a physical blow. Her brand new dream car was gone forever, and she was now expected to write a check to her bank for nearly $6,000 for a car that no longer existed. She would be spending the next year paying off a ghost, a pile of scrap metal sitting in a junkyard, all while having no car to get to the new job she'd been so excited about. She had full coverage, but she was on the hook for thousands. This nightmare scenario is what gap insurance is designed to prevent. GAP stands for Guaranteed Asset Protection. It's a separate, optional coverage that pays the difference between the actual cash value of your vehicle and the amount you still owe on your loan. If Jessica had paid for gap insurance, it would have written a check for that $5,700 difference. It would have made her financially whole. She would have walked away with no car, yes, but also with no debt, free to get a new loan and start over without this massive financial anchor dragging her down. So, how do you know if you need it? You are a prime candidate for gap insurance and should absolutely get it if you meet one or more of these conditions. First, you made a small down payment or no down payment at all. A general rule of thumb is if you put down less than 20%, you're almost certainly upside down on your loan, meaning you owe more than the car is worth. Second, you financed your car for a long term. 60 months used to be the standard, but now it's common to see 72 or even 84-month loans. The longer the loan term, the slower you build equity, and the longer you'll be upside down. Third, you rolled negative equity from a previous car loan into your new one. This is a huge red flag. It means you were already upside down on your last car, and you've just piled that old debt on top of your new debt. You are starting your new loan thousands of dollars in the hole, and you desperately need gap coverage. Fourth, you bought a vehicle that depreciates faster than average. This includes many luxury brands, certain domestic models, and cars that are redesigned the year after you buy yours. A quick Google search for your car's model and depreciation rate can be very revealing. And fifth, you drive a lot. The more miles you put on your car, the faster its value drops, widening that potential gap. Now for the most valuable piece of advice I can give you on this topic. When you buy a car from a dealership, the finance manager will almost always try to sell you gap insurance. They'll present it as a simple, must-have addition to your monthly payment. Do not automatically say yes. Dealerships are notorious for marking up the price of gap insurance by 2, 3, or even 400%. They'll sell you a policy for $800, $900, even over $1,000, and conveniently roll it right into your loan. This means not only are you overpaying for the policy, but you're also paying interest on that inflated price for the entire life of the loan. It's a massive profit center for them. Here's what you do instead. Before you sign the papers, tell the finance manager you're interested in gap, and ask for the price in writing. Then, right there in the office, call your auto insurance agent. Ask them how much it would cost to add gap coverage to your existing auto policy. I can almost guarantee you the difference will be staggering. Your insurance company might only charge you $5 or $6 a month. That's maybe $72 a year. Over a 5-year loan, that's $360. The dealership was trying to sell you the same or often inferior protection for $900 plus interest. By making one phone call, you can save yourself hundreds and hundreds of dollars. Finally, remember that you don't need gap insurance forever. It's not a lifetime commitment. Its only job is to protect you while you're upside down. The moment you owe less on your car than it's worth, you no longer need the coverage. Periodically, maybe once a year, look up your car's current market value on a site like Kelley Blue Book, and then check your loan's remaining balance. The day your car is worth more than you owe, you have equity. You've closed the gap. On that day, you call your insurance company and cancel the gap coverage and save yourself that extra money each month. Protecting yourself from that financial gap is a non-negotiable for millions of drivers. It turns a potential financial catastrophe into a manageable inconvenience. So you've now protected your car, your health, and your finances from a major crash. But what happens when the crash is just a tiny fender bender? A little tap in a parking lot. You might think, I'll just pay for it myself, keep my insurance out of it to avoid my rates going up. But this common, seemingly smart decision can lead to one of the most financially devastating traps a driver can fall into. Tap in a parking lot. You might think, I'll just pay for it myself, keep my insurance out of it to avoid my rates going up. But this common, seemingly smart decision can lead to one of the most financially devastating traps a driver can fall into. Let me tell you about a guy named Mark. Mark was a careful driver, had a clean record, and found a great deal on his insurance. One afternoon, he was backing out of a tight spot at the grocery store and gently bumped the car behind him. It was a classic fender bender. A tiny scratch on the other driver's bumper. A small dent on his own. The other driver, a woman named Susan, seemed perfectly fine, just a little annoyed. "Look," Mark said. "I am so sorry. This is totally my fault. Let's not get insurance involved, it's just a headache. How about I give you $500 cash right now to get that scratch buffed out?" Susan thought about it for a second, looked at the minor damage and agreed. Seemed like a win-win. Mark avoided a claim. Susan got some quick cash for a minor inconvenience. They shook hands, didn't exchange insurance info, didn't call the police. Mark went home feeling like he'd dodged a bullet. 3 weeks later, a certified letter arrived at his door. It was from a personal injury law firm. The letter stated that their client, Susan, had suffered severe whiplash and a debilitating back injury as a result of the violent collision in the parking lot. She was seeking damages for medical bills, ongoing physical therapy, lost wages, and pain and suffering. The initial demand was for $75,000. Mark's blood ran cold. He immediately called his insurance company, frantically explaining what happened. The agent on the other end listened patiently, and then delivered the gut punch. "Sir, your policy requires you to report any and all incidents that could potentially lead to a claim in a timely manner. Because you waited 3 weeks, because there's no police report, and because you admitted fault and attempted to settle it yourself, we may have grounds to deny the claim due to a breach of your policy contract." Mark had walked right into the trap. By trying to save a few $100s on a potential rate hike, he was now staring down a 5-figure lawsuit, completely on his own. This brings us to the 9th and arguably one of the most crucial questions you must ask before buying car insurance. What is your claims process, and what are the consequences of not reporting an accident? Every insurance policy you buy is, at its core, a contract. And buried in the fine print of that contract is a clause called the duty to notify, or prompt notice provision. It legally obligates you to inform the insurance company of any accident, no matter how small, as soon as it's reasonably possible. Why? Because their ability to defend you depends on it. An insurance company's investigation team needs to act fast. They need to see the cars before they're repaired. They need to take photos of the scene before the skid marks wash away. They need to talk to witnesses while memories are still fresh. When you wait like Mark did, you tie their hands. Evidence disappears. Stories change. A tiny scratch becomes a crumpled bumper. A moment of annoyance becomes severe emotional distress. By not reporting it, you prevent the insurance company from doing the very job you pay them to do, protect you. And the consequences can be catastrophic. First, as Mark discovered, is the potential for a denial of coverage. The insurer can argue that your failure to report prejudiced their ability to investigate, and they can wash their hands of the whole situation. If they deny your claim, you are suddenly uninsured for that specific incident. This leads to the second, more terrifying consequence: full personal liability. That $75,000 lawsuit? It's now Mark's problem. The legal fees to hire a lawyer? Out of his pocket. If he loses in court, they can go after his savings, his investments, even put a lien on his house. His entire financial future is on the line. All because he wanted to avoid reporting a tiny scratch. So what should you do? What is the right way to handle any accident, no matter how insignificant it seems? First and always, ensure everyone is safe and move the vehicles out of traffic if possible. Second, call the police. I don't care if it's a 2 mile per hour tap. A police report is an objective, third-party account of the incident. It documents the time, the place, the parties involved, the visible damage, and often includes a preliminary assessment of what happened. This single document can be the silver bullet that shuts down a fraudulent claim before it even begins. If Susan's lawyer tried to claim a violent collision, a police report noting minor cosmetic damage, no injuries reported, would be Mark's greatest defense. Third, gather your own evidence. Use your smartphone. Take photos of everything. Your car, the other car, the license plates, the street signs, the weather conditions. Take a wide shot of the entire scene. Get a video if you can. You cannot have too much evidence. Fourth, exchange information. Get their name, address, phone number, and critically, their insurance company and policy number. Give them yours. But this is important: do not apologize. Do not admit fault. Asterisk asterisk, don't say, "I'm so sorry, it was my fault." Simply state the facts. I was backing up and our vehicles made contact. Admitting fault at the scene can be used against you later. Let the professionals determine fault. And fifth, call your insurance company immediately. Right there from the side of the road. Let them know what happened. This officially starts the process. It fulfills your contractual obligation, and most importantly, it activates your shield. Your insurance company's massive legal and financial resources are now on your side. I know what you're thinking, but my rates will go up. And yes, they might. An at-fault accident will likely increase your premium. But let's do the math. A potential rate increase might be, say, $40 a month. That's $480 a year. A lawsuit, on the other hand, can cost you tens or even hundreds of thousands of dollars. It's not even a close call. Paying a slightly higher premium is infinitely better than financial ruin. You pay for insurance to use it. Not using it when you need it is like paying for a bodyguard, and then telling him to go home right before you walk down a dark alley. This all ties into the second half of our question. What is the company's claims process like? This is where an insurer shows its true colors. A cheap policy from a company with a terrible claims department is worthless. When you call to get a quote, ask them to walk you through it. Ask, if I get in an accident today, what happens next? A good company will have a clear, streamlined process. You'll be assigned a specific claims adjuster, who will be your point of contact. They should be responsive, returning your calls and emails promptly. They will conduct a thorough investigation, reviewing your evidence and the police report. They will send an appraiser to assess the damage to your vehicle, or they may have a network of approved, reputable body shops. They will handle all communication with the other driver and their insurance company. They are your advocate. Be wary of red flags. If a company is known for constantly switching your adjuster, making it impossible to get a straight answer, that's a bad sign. If they pressure you to use a specific repair shop that isn't well regarded, that's a red flag. If their customer reviews are filled with complaints about lowball settlement offers and endless delays, run the other way. The J.D. Power Auto Claims Satisfaction Study is a great, unbiased resource to check before you buy. Remember, the claims process is the moment of truth. It's the product you are actually buying. The monthly premium is just the price tag. You're not buying a piece of paper. You're buying a promise. A promise that when things go wrong, when you're standing on the side of a highway, shaken and scared, a massive professional organization will step in and make it right. Choosing an insurer with a transparent, supportive, and fair claims process is non-negotiable. It is the difference between an inconvenience and a catastrophe. It ensures that a bad day doesn't turn into a bad life. So you found a company with a great claims process. You understand the absolute necessity of reporting every incident. You've got the right coverages we've discussed before. You feel protected, but there is one final piece of the puzzle. One set of numbers on your policy's declaration page that most people glance over, but it is, without a doubt, the single most important factor that will determine whether you walk away from a serious accident financially whole or financially destroyed. It's the ultimate safety net, and 90% of drivers don't fully understand what it means. And so we arrive at the final question. Question number 10. This isn't about saving $10 a month. It's not about roadside assistance or rental cars. This is the question that cuts through all the noise, all the jargon, all the cute commercials with the talking animals. This is the question that, without a doubt, the single most important factor that will determine whether you walk away from a serious accident financially whole or financially destroyed. It's the ultimate safety net, and 90% of drivers don't fully understand what it means. The 10th and final question you must ask is, what are my liability limits, and are they actually high enough to protect my life? Let's break that down. Liability coverage has nothing to do with fixing your car. It has nothing to do with your medical bills. Liability is your financial shield. It's the money your insurance company pays out to other people when you are at fault for an accident, for their destroyed car, their medical bills, their lost wages, their pain and suffering. It is the one coverage that stands between a simple mistake on the road and losing everything you own. On your insurance policy, you'll see it written as 3 numbers, separated by slashes. Something like 25/50/25, or 100/300/100. It looks like code, but it's the most important code you'll ever need to crack. The first number is the maximum amount in thousands your policy will pay for bodily injury to a single person in an accident you cause. So a 25-foot means $25,000. The second number is the maximum amount your policy will pay for bodily injury for the entire accident, no matter how many people are hurt. A 50 means $50,000 total. The third number is the maximum amount your policy will pay for property damage in an accident you cause. That's the other person's car, but it could also be a storefront, a telephone pole, or a fire hydrant. A 25-foot here means $25,000. Now, every state in the US has a legal minimum limit you're required to carry. And for millions of people, this is where the nightmare begins. They call an agent or go online and say, I just need the cheapest possible coverage to be legal. And what they get is a policy with state minimum limits. In many states, that's 25/50/25 or even lower. And they think they're covered. They think they're safe. They are dangerously, catastrophically wrong. Let me paint you a picture. Let's say you're a good driver. You've been driving for 15 years, never had an accident. You have a decent job, maybe $50,000 in a 401k, a little bit of equity in your home. You're doing everything right. You have the state minimum 25/50/25 insurance policy, Because it saves you about 20 bucks a month. One rainy afternoon, you're approaching an intersection. You glance down at your phone for just 1 second to check a notification. 1 second. When you look up, the light is red. You slam on the brakes, but it's too late. You slide into the intersection and T-bone a brand new Audi. The driver of the Audi is a dentist. Her husband is in the passenger seat. They are both injured. The police report finds you 100% at fault. A few weeks later, the letters start to arrive. First, the property damage. The Audi is a total loss. The replacement cost is $90,000. Your insurance policy, your legal state minimum policy, has a property damage limit of $25,000. Your insurance company writes a check for $25,000 and wishes you the best of luck. You are now personally on the hook for the remaining $65,000. That's your first bill. Next, the bodily injury. The dentist suffered a complex wrist fracture. She requires surgery and can't work for 6 months. Her medical bills are $80,000. Her lost income from not being able to practice dentistry is $200,000. Total claim, $280,000. Your policy's bodily injury limit per person is $25,000. Your insurance company writes a check for $25,000. You are now personally on the hook for the remaining $255,000. Her husband in the passenger seat had less severe injuries, but still, his medical bills and lost wages come to $40,000. Your policy pays out its limit for him, another $25,000. You now owe him the remaining $15,000. Let's add it up. You owe $65,000 for the car. You owe $255,000 to the dentist. You owe $15,000 to her husband. Your total out-of-pocket bill for that 1-second glance at your phone is $335,000. Your insurance policy, the one you paid for every month, covered a measly $75,000 of a $410,000 accident. The other party's attorney will sue you. They won't just ask for the money. They will take it. They will get a judgment against you. They will liquidate your 401k. They will put a lien on your house, forcing you to sell it. And after all of that is gone, they will garnish your wages. For the next 10, 20, maybe 30 years, a portion of every single paycheck you earn will be taken from you before you ever see it, to pay for a mistake you made in a single second. You save $20 a month, and it cost you your entire financial future. This is not a scare tactic. This happens every single day in every single state in this country. State minimum liability limits are a financial trap, designed only to make you legal, not to make you safe. So how much is enough? The standard advice from any reputable financial planner is simple. You should have liability coverage equal to or greater than your net worth. Why? Because if you have assets, you are a target. If you have $100,000 in assets and you cause a $300,000 accident, the lawyers know you have something to lose. They will come after it. But if you have $100,000 in assets and you carry a policy with 500/500/100 limits, something changes. Now it's not just you against their lawyer. It's your massive insurance company and their team of high-powered attorneys against their lawyer. The insurance company has the deep pockets to pay the claim and the legal muscle to defend it. You become the small fish. They go after the big one, your insurer. Your assets, your home, your savings, they're shielded. And here is the most crucial part of this entire video. The part that most people never realize. The cost to increase your liability limits from the pathetic state minimum levels to a level that actually protects you is almost nothing. It is the single greatest bargain in the world of insurance. Jumping from a 25/50/25 policy to a 100/300/100 policy. 4 times the bodily injury protection and 4 times the property damage protection. Might cost you an extra $15 or $20 a month. The price of 3 lattes. Jumping from there up to 250/500/100, 10 times the protection of the state minimum, might be another $10 or $15 on top of that. For less than $1 a day, you are buying a financial fortress around your life. You are buying the peace of mind of knowing that one bad day on the road won't bankrupt you and your family for the rest of your lives. And for those of you who have a higher net worth, or who simply want the ultimate level of protection, there is one more layer: an umbrella policy. An umbrella policy is a separate insurance policy that sits on top of your auto and home insurance. It only kicks in after your primary limits are exhausted, and it provides an extra $1 million, $2 million, or even $5 million of liability coverage. And the cost? It is shockingly cheap. A $1 million umbrella policy often costs just $200 to $300 per year. So as we wrap this up, I want you to do something. Don't just click away to the next video. I want you to pause this, get up, and find your car insurance policy. Find the document called the declarations page. And I want you to find those 3 numbers. Look at them. Now think about your savings. Think about your home. Think about the future you're trying to build for yourself and your family. Think about your kids' college fund, your retirement dreams. Then look back at those 3 numbers on the page and ask yourself the final question. Are you willing to bet everything you have ever worked for and everything you ever will work for on the hope that you never have one bad day, one moment of distraction? Don't just buy insurance to be legal. Buy insurance to be protected. Because the cheapest policy is almost always the most expensive one you can own.